The Federal Reserve is about to cut interest rates, a decision that sends ripples through every corner of the financial world. This isn't just a technical adjustment, it's a signal that can shift the entire economic landscape, influencing everything from mortgage rates to the value of your retirement savings. When the Fed makes its first move, it sets the tone for the financial markets. Investors, analysts, and institutions all pay close attention, knowing that this initial step often dictates the pace and direction of the months to come. The first 90 days after a rate cut are especially critical. During this window, major money managers and institutional investors rapidly reassess their strategies, deciding where to allocate billions of dollars. Their choices can cause dramatic shifts in stock prices, bond yields, and even global markets, ultimately impacting everyone's portfolios, whether you're a seasoned investor or just starting out. Previously, high interest rates made holding cash in savings accounts attractive, offering safe returns. But when rates drop, those safe havens lose their appeal, and investors are pushed to seek higher returns in riskier assets like stocks, real estate, or even alternative investments. This period becomes a proving ground, revealing which market leaders and sectors are poised to thrive in the new environment. Some industries may surge ahead, while others lag behind, creating both opportunities and risks. Understanding these shifting dynamics is essential. By staying informed, you can make smarter, more confident decisions about where to put your money and how to balance risk and reward. This isn't the time to be passive or complacent. The actions you take now could shape your financial future for years to come, so it's important to review your strategy and adapt as needed. The next 90 days will directly affect your investments, your savings, and your long-term goals. Every decision counts, and timing can make all the difference. By understanding how money flows after a rate cut, and learning from historical precedents, you empower yourself to make smarter, more strategic choices, no matter what the markets do. Stay informed, stay proactive, and don't hesitate to seek advice or adjust your plan. Protecting and growing your wealth requires vigilance and action. Remember, this is your money, your future, and you need to be in control every step of the way. Today, September 11th, 2025, there's $7.2 trillion in U.S. money market funds, waiting for the right moment. With high rates, cash was safe, but a rate cut is imminent, signaling a shift. The futures market predicts a rate cut, ending the high-rate era. This could move cash back into the market, despite skepticism about a gradual shift. Even a slow flow from cash can have a big impact, like a dam opening. The market, dominated by tech giants, faces a unique tension with cheaper borrowing costs. The question is, where will this energy go? The answer will define market winners and losers. Understanding this setup is key to navigating the next market phase. To predict the future, we must first look back and truly understand the lessons history has to offer. The financial world is shaped by cycles, periods of growth, contraction, and recovery. By examining how markets and policymakers responded to past challenges, we gain valuable insight into what might come next. We must understand the past, not just as a series of dates and numbers, but as a living story of human behavior, fear, and hope. Each rate cut tells a different story, shaped by the context of its time. In 2001, the Federal Reserve slashed rates in the aftermath of the dot-com bubble bursting. Despite these efforts, fear dominated the markets, and stocks continued to fall. The cuts, though significant, couldn't immediately restore confidence, as uncertainty and panic gripped investors. Fast forward to 2008, and the world faced an even deeper crisis. The rate cuts then were not just policy adjustments, they were desperate attempts to save a collapsing financial system. Banks were failing, credit froze, and the global economy teetered on the edge. Both in 2001 and 2008, the Federal Reserve's actions were reactions to crises, not measures to prevent them. The cuts came after the damage had begun, serving as lifelines rather than shields. But 1995 was different. That year, the Fed made mid-cycle cuts before a full-blown slowdown could take hold. This preemptive move boosted market confidence, signaling that the central bank was ahead of the curve and willing to act decisively to support growth. The market thrived as the Fed acted from a position of strength, not weakness. Investors responded with optimism, fueling a rally that extended the economic expansion. In 2019, the story was similar. The Fed cut rates proactively amid trade tensions and global uncertainty. This time, the move was seen as a safeguard, not a rescue, and markets responded with a strong rally. Today, the situation feels much like 2019, a proactive move designed to engineer a soft landing for the economy rather than a panicked response to disaster. Understanding these scenarios helps us anticipate how markets might react to the next rate cut. Will it be seen as a sign of strength or a signal of trouble ahead? Rate cuts can signal either strength or desperation. Knowing the difference is crucial for investors as it shapes expectations and risk appetite. The current cut aims to ensure stability and maintain momentum, not to react to a sudden crash. It's a calculated move to keep the economy on track. Investors should watch for signals of confidence in the market. Rising risk-taking, positive sentiment, and strong earnings can all indicate that the cut is working as intended. A proactive Federal Reserve can encourage risk-taking and fuel further market growth, as long as the underlying fundamentals remain solid. History shows that well-timed cuts can extend economic cycles, giving businesses and consumers more time to invest, spend, and grow. The upcoming cut is a strategic move, designed to maintain growth and avoid the pitfalls of past crises. It's about steering the economy, not saving it from disaster. Investors should prepare for potential market shifts, reviewing their portfolios and staying alert to changing conditions. The past offers invaluable lessons for navigating today's economic landscape. By studying previous cycles, we can better understand the signals and avoid common pitfalls. A proactive approach by both policymakers and investors can open the door to new market opportunities and sustained growth. Understanding historical patterns and the context behind each rate cut helps investors make more informed, confident decisions. The Fed's actions today echo the most successful strategies from the past, offering hope that, with the right moves, the economy can continue to thrive. If the rate cut is a green light, focus on small-cap stocks. These smaller companies offer growth at a discount compared to mega-cap tech stocks. Small caps are sensitive to rate changes, benefiting from lower interest payments. Historically, small caps outperform after rate cuts, with significant gains. A lower rate environment aids their growth and expansion. Small caps are nimble, ready to seize opportunities quickly. The smart money is eyeing small caps for their potential. It's time to explore opportunities in the small cap space. When cash moves, it follows a flow ladder from safe to riskier assets. It starts with short-term government debt, like T-bills, as cash yields drop. Next, money flows into longer-term bonds, benefiting from falling rates. This bond phase signals returning market confidence. Finally, cash moves into equities, marking a risk-on moment. Small caps, seen as riskier, benefit last but significantly. This classic post-rate cut playbook guides investor sentiment. Watching this flow helps position your portfolio strategically. If money stalls at bonds, fear persists. If it flows to stocks, confidence reigns. Understanding this flow is key to navigating market changes. The future holds different scenarios, each favoring different investments. A soft landing boosts cyclical sectors like industrials and consumer discretionary. Sticky inflation favors defensive sectors like healthcare and utilities. Tariff rollbacks could ignite a market boom, benefiting all sectors. Each path impacts your investments differently. Diversification is crucial to navigate these potential outcomes. A soft landing rewards growth investments. Sticky inflation favors stability. Tariff removal could create a broad-based rally. Stay prepared to adjust your strategy as the future unfolds. Understanding these scenarios helps in making informed decisions. A diversified portfolio is essential for navigating uncertainty. Be ready to recognize signs and adapt your investment approach. A lower rate environment doesn't solve all problems. Risks remain. While lower interest rates can provide some relief, they are not a panacea for the underlying issues plaguing many businesses today. The economic landscape is fraught with challenges that extend beyond the cost of borrowing. Corporate bankruptcies are rising, a warning sign for investors. This trend indicates deeper systemic issues that could have long-term repercussions. Investors need to be vigilant and discerning in such an environment. Many companies, especially small ones, are fragile under debt pressure. The burden of debt can be overwhelming, leading to a precarious financial situation for many small businesses. They often lack the resources to weather prolonged economic downturns. A rate cut may come too late for some struggling businesses. For those already on the brink, Even significant rate reductions might not be enough to stave off closure. Timing is critical, and delays can be fatal. Be selective and avoid buying cheap stocks without research. In times of economic uncertainty, it's crucial to conduct thorough research before making investment decisions. Cheap stocks can be tempting but often come with hidden risks. Global economic shifts add unpredictability to the market. The interconnectedness of global economies means that shifts in one region can have ripple effects worldwide, adding layers of complexity and unpredictability. Central banks worldwide are not aligned, causing potential shocks. Divergent monetary policies can lead to market volatility and unexpected financial shocks, making it harder for investors to navigate the landscape. Currency fluctuations and economic surprises can impact the U.S. market. Exchange rate volatility and unforeseen economic events can have significant implications for the U.S. market, affecting everything from trade to investment flows. The story of a small-cap rally isn't a fairy tale. Risks are real. While small-cap stocks can offer high returns, they also come with high risks. Investors should be aware of the volatility and potential for significant losses. Corporate bankruptcy and global uncertainty are significant threats. These factors can create a challenging environment for businesses and investors alike, necessitating a cautious and well-informed approach. A strong financial foundation is crucial for weathering storms. Building a robust financial base can help individuals and businesses navigate through economic turbulence and emerge stronger. Maintain an emergency fund, avoid credit card debt, and diversify. These steps are essential for financial resilience, providing a buffer against unexpected expenses and market volatility. Be prepared for challenges, even when opportunities seem promising. It's important to remain vigilant and prepared for potential setbacks, even when the outlook appears favorable. Denial isn't a financial plan. Stay informed and proactive. Staying updated with the latest financial news and trends is crucial for making informed decisions and avoiding pitfalls. Let's explore a small-cap example. BioStem Technologies. This medical tech company focuses on regenerative therapies for chronic wounds. It's in a growing market, with strong revenue and profitability. BioStem's proprietary technology gives it a competitive edge. It's working to list on Nasdaq, increasing visibility. This example highlights what to look for in small-cap investments. Seek companies with growth potential, strong finances, and unique offerings. Let's summarize your action plan. Watch money flow. Are investors moving cash? Is the bond market rallying? These indicators reveal market confidence and risk appetite. Review your portfolio. Diversify beyond tech giants. Consider small-cap index funds for potential upside. Stay informed about corporate debt and global events. Rising bankruptcies or global tensions are warning signs. Stick to your long-term plan. Pay down debt, contribute to retirement. Ensure your emergency fund is ready for any storm. The next 90 days are crucial, but just one chapter in your financial journey. Be prepared, stay smart, and you'll thrive. Your financial strength will see you through.